It's not a positive development. What we need to remember is that supply shocks tend to have a negative impact on the global economy. If it's demand-driven, the price increase, it's less problematic, but supply shocks are problematic for the world economy.
I mean, how long are oil markets really going to be feeling the effects from the latest attacks? I mean, are we talking about weeks or months here?
It's still open because Saudi Arabia has not communicated on how long it takes to repair the damages, how the damages look alike. What we have heard, however, is that everyone tries to calm down markets. We had the Saudi indicating that they have sufficient stocks to cover the demand of the markets, but also we had out of the US the comments that they can use strategic oil reserve to cover demand if the market needs it.
Do you think that there's a permanent risk here that needs to be priced in?
What is different this time around to previous attacks is that here we have an attack that no one really expected. And it could happen at any time once again in the future with missiles or drones attacking Saudi facilities. Saudi Arabia seems not to be prepared for such attacks in the past. And with that the oil market can lose so large quantities in such surprising time, what it means is that the market needs to price in a political risk premium.
So given the situation today, and we have also seen oil prices spiking, what then is going to be your best and worst case scenario for oil prices, and what events could play into that?
What we have seen historically is when oil inventories in OECD countries decline by around 1%, that the oil price can increase by around 8% year on year. So essentially 1% decline in oil inventories is around 300 million barrels. If you take these 5.7 million barrels per day of disruption, then it's probably around 1.5 months of sustained disruption to see a price increase of 8%. So that's a rule of thumb. Obviously, we need to see how the situation evolves. If Saudi Arabia, there has been reports indicating that around 30% of the production can return back very quickly. So the outages will be less. With that, the upside is more limited, unless we get further attacks in future.
There were actually fears following the attacks that we could be seeing $100 a barrel in sight. What do you say to that? Is that too far-fetched?
I mean, if we look at the historical context, that's the largest disruption in historic terms. Even during the Iranian Revolutionary, we had less disruption. However, in percentage of oil supply, this time around it's less. We used to have 8%, 8.5% of disruption during the late 70s. Now it's around 5.5%. So that's one starting point. What is also different is that this time around we have still sufficient inventories, oil inventories, which we can use to offset this disruption. And the expectation is that it's rather something short-lived and not over an extended period. If we get such a similar outage over months, and we need to remember that the global economy doesn't have sufficient spare capacity. Spare capacity lies around 3.5 million barrels per day, and 70% thereof is in the hand of the Saudis. So no one can compensate this 5.7 million barrels per day. So if we get an extended production disruption, then we can get the 100. But that's not the base case.
No one could compensate. I mean, could the US play a role here in terms of making up for the shortfall?
We need to distinguish 2 points. On the one hand, what we have is we have strategic reserves to offset temporary disruptions. But if it's an extended disruption, these temporary strategic stock are not sufficient to cover. The second element relates to the US role, shale oil production, very short-term cycle production. In this context, it still takes months until the production increase would happen after a price increase. So short-term, no.
So US President Donald Trump actually said, OK, we can dip into the emergency reserves, but this is a rare move that is only used, I guess, for real emergencies. Do you think he's acted too fast on that?
That's probably the reason why the Energy Secretary Perry this afternoon came out with a more cautious statement saying, let's watch that, how the developments will be. We have heard also Saudi Arabia indicating once again to their customers that they have sufficient oil to cover their demand, so everyone tries to calm down. And also the International Energy Agency over the weekend has indicated that the market is well supplied and they stand ready to watch the developments. But at the moment, there is no need.
Right, so the latest attacks can be seen as a blow, but I guess from your perspective, who do you actually think stands to win or gain the most from the latest developments? Which countries and sectors, I guess?
In general, what we need to keep in mind is that higher oil prices are negative for oil consumers. So let's take Asian countries, emerging market in Asia, which consume a lot of oil. India is one country to mention. But also China, the largest crude importer, they're probably the one to suffer the most directly from higher import costs regarding the latest price increase. But if we remember where prices were trading 6 months ago, we were on similar levels, so it's not yet problematic from that side. Also, the country which should benefit are countries which produce oil. So let's name them. Russia is probably one of the main beneficiaries, which has still the potential to increase production, and also the other GCC country, which have cut production. They could be the direct beneficiaries. US shale indirectly, if prices remain at this level for longer. Industry-wise, obviously, a sector which consumes a lot of oil is the airline industry. They will be probably suffer if they have not hedged their production, but the declines today were rather muted.
And getting back into the everyday kind of impact on our lives, what about gas prices?
Yes, the consumer is also one to suffer. They will feel it directly. We need here.
So you don't think that there will be a delay in the effects from consumers? You think that it's going to kickstart straight away?
That will be very quickly. We have seen already in the US some prices increasing. Here in the US, it's the tax amount is very limited, so the direct impact, the direct increase goes faster. In Europe and the rest part of the world, the largest part of the oil price or gasoline price is driven by taxes, so the increase from the oil price is more limited. But we should still see price increases over the coming days, also here in Switzerland.
And of course, we are having this situation right now from Switzerland, one of the biggest commodity trading hubs in the world. How do you think the situation is being played out also here? What about commodity funds?
What I've seen today is that there has been more interest from the community investment activity. So market players have last week increased the speculative positioning and then cut it back last Friday with the removal of Bolton from the US administration. So this morning we have seen an increase in activity. So everyone tries to see and benefit from the news flows. The oil world offers more volatility than the other markets, also with higher risks, something investors need to consider when they invest in the oil world, but expect more activity also from trading houses due to the volatility.
And compared with last year, I mean, oil prices have been declining on softening demand, although they were actually up before the attacks. Where now do you see oil prices heading?
In the context of 2020, we expect the global economy to slow down next year further. Our world GDP number is at 3%. That's the lowest growth rate since the global financial crisis. So we expect oil demand to grow below trend at just 900,000 barrels per day year on year. So that's relatively a muted growth number. We need to remind ourselves that oil demand hasn't contracted in many times over the last 40 years. It was only during the global financial crisis that we had a year-on-year contraction. So if oil demand grows just 900,000, it's already a small growth rate. And also that non-OPEC supply next year we should still expand at a solid rate, 1.7, 1.8 million barrels per day. And here it's more projects being done already previously when the prices were higher. In Norway, we have the Johan Sverdrup oil field expected to produce 440,000 barrels per day by the end of the year. That supply comes into the market if the price is at 80 or if the price is at 50. And so the market will move from an undersupplied situation into an oversupplied situation, and that is likely to see oil prices declining. Will also depend how much the decline will be on how long the disruption materializes, how long it lasts, the disruption, in the context that if we start with lower inventories into next year, then the decline will be less.